Great. Again, my name is John Hobler, and I'm with CrossCountry Consulting. And on today's webinar, we're going to ask the question, is your tech ready for RevRec? I'm joined by a trio of experienced folks on this topic. Adam Washeka is my colleague at CrossCountry. He's going to cover a lot around the new policy from an accounting perspective. And we're really pleased to be joined by two product technology experts, Risha and Mike. They work with a product called Workday, but they're really going to cover what a technology solution can do for you as Adam goes through the challenges of implementing 606 and all the different scenarios you see. They will just introduce themselves when they hop in through the call. Before we get into the content, I wanted to cover a few administrative items. This is a CPE worthy presentation, but some basic rules, as you know, to get CPE credit. You need to attend for at least 50 minutes, and you also need to respond to all three polling questions. The polling questions will appear on your media player, which is the little app that came up when you launched the GoToWebinar, and all the questions will be at the end. So right around the 50-minute mark, that's when we'll do the polling questions. These are two critical things for us to be able to issue CPA per the governing body. If you have a question, there's a questions box, an ask a question box on the media player. You can ask your question there. We will moderate them. And at the end, if we have time, we will get to some of those questions in the Q&A portion. Some of the learning objectives of this class are to understand the basics of the RevRec model and its 5 steps. 2, what are some of the key implementation challenges? And we're going to talk about a deep dive really on 2 things that we here at CrossCountry see companies struggling with the most or trying to figure out how to handle the most, is contract modifications and also variable considerations. Finally, we're going to cover how you can use technology to help implement these policies and to reduce the time and cost, improve auditability and reporting, and make this a lot easier going forward to make sure you're compliant with the standard. On our agenda today, we're going to cover 4 main sections: an overview of ASC 606, the implementation challenges around contract and variable consideration. In the second part, you'll hear Adam speak a little bit about the policy and what it means, what the accounting treatment is, and provide a lot of real-world examples. And then Risha is going to talk about how technology can help solve those. And then the third will be other technology considerations, not directly related to these two, but what we see most common that our customers, our joint customers, are really dealing with. Lastly, we'll have some time for Q&A from our participants. And also keep in mind that we do have those 3 polling questions right at the end, so please stay to the end for the polling questions as it relates to the CPE credit. At this point, I'm going to turn it over to Adam, and he's going to talk about the new standard. Adam?
Thanks, John. Good to be here today. I apologize in advance for any of you that have seen this slide on the 5-step model a million times already. I promise I won't spend a lot of time on it, but do realize, some of you on this webinar may not be familiar with it yet, so just provide a bit of context and a bit of background. We wanted to quickly go through it. So really the essence of this new revenue recognition standard, it provides for a 5-step model that are applied to all contracts with customers. So whether you're a government contractor building a new aircraft carrier for the Department of Defense, or a social media company selling advertising on your website, you're going to be following the same 5-step model to determine how revenue should be recognized for those contracts. So just to quickly walk through this model, step 1 is identify the contract. Often that'll be straightforward. It could be the purchase order, the sales order, the SOW, anything that creates legally enforceable rights and obligations. Step 2 then is you determine within that contract, what are your performance obligations? This is kind of similar to the concept of units of account in today's revenue recognition guidance. It's really, how do you break up that contract into the units in which you will do the accounting? Step 3 then is you determine what is the transaction price. So obviously that's any fixed consideration you're going to receive, but then in a big change in today's guidance, you also would estimate variable consideration, which is one of the topics we're going to dig into today. Step 4 then is you now have your performance obligations, your transaction price. You now allocate that transaction price to the performance obligations based on what's known as a relative standalone selling price method. And this is really conceptually similar to the allocation principles in today's guidance. Finally, in step 5, you get to recognize revenue. So for each performance obligation, based on the amount that was allocated to the performance obligation, you recognize revenue as that performance obligation is satisfied. So kind of conceptually, I think it makes a lot of sense, but obviously with that, like with everything, the devil's in the details. So in addition to the accounting, the new standard also provides for extensive new disclosures from both a qualitative and quantitative perspective. Some companies are finding they really don't have any changes from an accounting perspective, but they're realizing the disclosures are providing a pretty significant challenge and realizing their current systems and processes may not provide all the data that is needed for these disclosures. And finally, most of the standard deals with the credit side, the revenue side but it also actually addresses the contract costs as well, and potentially leading to additional costs being capitalized or not being capitalized today. I think the most prominent being commissions. A number of companies are finding they're going to have to capitalize commissions, which today are being expensed. So just one other quick point to note. I think as I go through these slides, you'll hear me use the terms ASC 606 and ASC 605. ASC 606 is the area within the US GAAP codification that contains this new revenue standard. So you can think of it as synonymous with the new revenue recognition standard. ASC 605 is the area in the codification related to current revenue recognition guidance. Okay, so as John said, we're really going to do a deep dive into two specific topics. And these are two topics that are really changing from today's world of revenue recognition, and also are topics that we're finding are presenting a significant challenge, both from a technical analysis, but also from an operational perspective. So I'm going to provide an overview of the accounting requirements and practical considerations, and I'm going to turn it over to Risha to really provide then some of the IT or system considerations around these topics. So if we want to start with modifications, and with as much guidance as currently, as much revenue recognition guidance as currently exists today, believe it or not, it really does not address modifications. There's not a robust or comprehensive model on how to treat contract modifications today. 606 changes that. It now provides this robust model. So I think what you have is today, you'll see diversity in practice. You don't necessarily all companies accounting for contract modifications the same way. And because now ASC 606 does provide this comprehensive model, I think we're going to see companies are going to have changes in this area. Or at the very least, they're going to have to take a fresh look at how they account for contract modifications, determine if there will be a change. So as you can see from this slide, a contract modification, it can change either the price of the contract, the scope of the contract, or both. And you would account for a contract modification when it creates new or changes existing enforceable rights and obligations. And this concept of enforceable rights and obligations is really a legal term. So obviously, if you have a signed change order, that's going to create legally enforceable rights and obligations. But potentially, even an email, or in some cases, even just a verbal conversation could create new or change these existing enforceable rights and obligations, which could actually lead to accounting for a modification earlier than you do today. So I just gave a quick overview of what is a contract modification. Now let's dig into what the accounting is for it. And depending on the nature of the modification, there's really three main accounting outcomes, or accounting outcomes of how you would treat a contract modification. And I thought it would make sense to just use a few simple examples to kind of explain these concepts. So in scenario one, this is where you would treat the contract modification as a new contract. And this would be the case when the modification adds distinct goods or services, and those distinct goods or services are at standalone selling price. So looking at this fact pattern, the contract is to provide consulting services for a 12-month period for $120,000. After 8 months, the parties agree to extend the contract for an additional 12 months for $120,000 and assume each month of service is distinct. So a couple points to note here. First, this concept of distinct. That's really a step two to identify the performance obligations concept. Like, is the promised good or service, is it dependent in any way on other promised goods or services, or does it provide value to the customer independent of the other promised goods or services? So let's just assume in this example that the entity is a law firm, and the contract is a legal retainer contract, where the law firm is just standing ready to provide legal advice as needed on a monthly basis. So if you think about it, the customer obtains value from each month of service independent of the other months of service. So because of that, each month would be distinct. So that's one of the key requirements to treat the modification as a new contract. The second is the added goods or services has to be at standalone selling price. And in this example, that would be the case because you see that the 12 months of service in the initial contract is 120,000. The 12 months of service in this renewal contract is also 120,000. So because of that, these distinct services were added at standalone selling price. So what this means from an accounting perspective is that initial contract, you would continue to account for it as is, as if it wasn't even modified, and then this renewal would be treated as a completely separate contract. You would start recognizing revenue upon the commencement of those services for the renewal year. So I think relatively straightforward. I think that's probably the easiest of the three scenarios to kind of grasp and to account for. So now let's look at scenario 2. So this is termination of the existing contract and a creation of a new contract. So what this says, you have a modification and you fall within this scenario, you view it as you're terminating that existing contract at the date of modification and creating a new one. Any remaining services from the initial contract would be carried forward to the new one, and any remaining transaction price that wasn't previously recognized would be carried forward to the new contract. So looking at this fact pattern, it's actually very similar to the fact pattern in scenario 1, with the one difference being that the extension of the 12 months is only for 60,000 instead of 120,000. So because of this, you see these while the additional services are distinct, they're not priced at standalone selling price. So because of that, you fall within the scenario where you treat it as a termination of existing contract and creation of a new. So kind of what that means from a numbers perspective in this example is, as of the date of the modification, assuming it was straight line revenue recognition, the entity would have recognized $80,000 of revenue, 8 months of service, $10,000 per month. So at the point of the modification, you still have $40,000 left to recognize on the original contract, plus the $60,000 in the new contract. So you now have a $100,000 transaction price for this new contract, and you now have a 16-month period of service, the 4 remaining months from the first contract plus the 12 renewal months. So you take that $100,000 divided by 16, this entity would then recognize $6,250 per month going forward, from month 9 through the end of the contract term. That's scenario 2. Scenario 3 is where it's treated as just a continuation of the existing contract, not a new contract at all. And the end result of this scenario would be a cumulative revenue adjustment. So again, scenario 3, similar to scenario 2 fact pattern, with the one difference being the entire service is a single performance obligation. So let's say the consulting services are to implement a new system for a customer. And for whatever reason, there's delays, and now they need to extend it. They think this implementation is going to take an extra 12 months. So those additional 12 months, it's not adding additional distinct goods or services. It's still one performance obligation to implement that system. So what that means is, when this modification, you just treat it as a continuation of the existing contract. So working through the numbers, again, through 8 months, the entity would have recognized $80,000 of revenue. At the point of the modification, now you say, well, really, this should be viewed as a 24-month contract with a $180,000 transaction price. So if you are always following that treatment, it would be $7,500 of revenue that would have been recognized each month. So through 8 months, there only would have been $60,000 of revenue recognized based on these new contract terms. You compare that to the $80,000 that actually was recognized, there would actually be a revenue reversal as of the point of the modification of this contract. And from that point forward, would continue to recognize $7,500 per month as revenue. So a lot of information there. We could probably spend another 2 hours just discussing the technical merits, but hopefully that gives you a good background of just kind of the general accounting requirements related to modifications under 606. So with that accounting in mind, I just want to now go through a couple practical considerations. So first one here is, have all contract modification scenarios been identified and the appropriate accounting concluded on? So, ideally, through the assessment or through the technical analysis phase, companies will have done this. They will have identified what are all the various types of modification scenarios my contracts could have, and what is the appropriate accounting, which of those 3 scenarios does it fall within. If you can do that, you can then create kind of a detailed policy and procedures manual for the revenue accounting team to follow. You can really make it almost like a factory. What I found, though, is this isn't realistic for most companies because there's so many types of modifications. It's just hard to get your arms around every specific scenario that could be out there. So really what that means then is, an ongoing basis, companies are going to have to assess contract modifications on a case-by-case basis. To the extent you can standardize, you want to do that, but realistically, I think most companies will find there's going to be some element of kind of case-by-case analysis that's going to be needed. So in addition to the ongoing, companies also need to consider what are the impacts on the cumulative, the transition adjustment. So if you do identify changes in the accounting for modifications between current revenue recognition and new revenue recognition, those contracts that have those modifications have to be isolated, and you're going to have to calculate what the impact is as of your transition date of adopting the new standard. Not going to go into detail on this now, but the ASC 606 does provide a practical expedient that you can use related to modifications. At the end of the day, I don't think it helps that much, but something you do want to consider. And then from an ongoing perspective, have you developed your process to account for modification? So the way I see it, you need a process to identify when a modification happens, and then determine what is appropriate accounting. Which of those three scenarios from the slide we just went through. And then once you know what the accounting should be, how do you actually account for it? And this, I think, is where we get into when you want to consider, is there an opportunity to leverage your systems or an IT solution? For example, thinking about the third scenario, the continuation of the existing contract, is there a way to have the system calculate that cumulative impact adjustment, or is this all going to have to be done offline in Excel? So I think with that, it's a good transition to Richa to start discussing some of these system implications around modifications.
Yep.
Fantastic.
Go ahead, Richa.
Thanks, Adam and John. Great introduction to the topic of contract modifications. So what I want to cover is how does Workday handle these various contract modification scenarios? What tools do we have that will help with, these various contract modifications that Adam discussed, and perhaps even more as you are uncovering them, as you go through your assessment phase. So Workday will support contract modifications today and going forward for ASC 606 as part of our revenue management solution. So when we say revenue management in Workday, it's really the full contract of cash. So you create the contract in Workday, you can do it either manually, or most often you do it through an integration with upstream CRM or a CPQ solution. So once the contract is in Workday, you can start your billing and revenue recognition. Down the road, if the customer agreement is modified for any of the reasons that Adam highlighted, or even others, the way we would change the contract is to go through an amendment process. So the key thing here that we've tried to design the system with is the tool should be flexible to allow you to handle these various modifications. And we believe that Workday Revenue is flexible enough to allow you to decide how you want to handle particular contract modification scenarios, and do that in as automated fashion as you can. So the ways we do that today is, you can modify the current approved transactional contract through what we call an amendment process. I talked about that. That's the key thing, and I'll go into a little bit more detail of what that is through a process flow later, but that's something to keep in mind. The primary tool is the amendment process. If you are doing modifications to specific details, such as a contract line, for example, if you're increasing the number of users for a subscription contract, once you've kind of done 6 months of work, you can process what we call the change order on the contract line and capture those changes at the line level. So that's a second variation of how you could do a modification. And then the third way we allow that is you're not really amending existing transactional contract, but you are choosing to create a new contract. In that case, you can create a new contract, do whatever changes you need to do, create separate performance obligations, the delta from where you are today. And then what we allow you to do is you can link the new contract that you've created to the existing one, which is your transaction contract. Specifically, if they're part of the same customer arrangement, you can link those two. And then you can do revenue allocation. You can do revenue allocation across the two contracts if that's a requirement. So linking is a very key feature that also helps you when you go through contract modifications. And all this can be automated using our web services framework. And we would track any change you make through our always on audit framework. So those are the key benefits, I guess, that I want to highlight, that with Workday, you definitely have the flexibility, and I'll showcase that through each of the scenarios. You have the flexibility in the tool set itself that will allow you to manage different types of modifications. The second thing is anything you're changing is audited and recorded. So we make sure that any change you make, whether it is a simple term change or big contract line changes, all that is audited. And that will give you the third benefit of when you're ready to report, or when you're doing your audits, you have everything that's been changed right in front of you. So flexibility, ease of reporting, audit, all that's kind of inbuilt with the Workday Revenue Management, which will really help you with contract modifications. Next slide. So I wanted to go through a process flow, a simple process flow of how we would do this using an example. But before I do that, one thing to note just for folks who are not familiar with Workday, I mentioned Workday Contract. That is the main container that's used to handle all contract modifications. So from a terminology perspective, that contract has a header and a line framework. At the header is where we capture all the key contract terms, bill to, ship to, addresses, etc. And then contract line is where we define what is being sold to the customer. So we support various types of revenue streams through that same contract. So whether you're doing subscription billing, usage, project time and expenses, or goods, all that can be modeled through the contract line framework. So there is a term called contract line type, which is pretty key in Workday, and it really helps you model these various revenue streams. It also determines what is available to you in terms of rev rec, billing, and things like that. So in my process flow, we created the initial contract, it went through an approval process, and it became a transactional contract. You can start your billing and rev rec based on separate billing and revenue schedules, pretty standard Workday functionality. As transactions are recorded against that contract, or as milestones are met, you can start doing billing, you can start your rev rec processes depending on the schedules you've created. At some point, let's say midway, the SOW is modified. That would require changing contract terms, dates, rev rec, multiple things, right? So that's where the contract amendment process would be initiated. And then once you initiate the process, you can modify whatever you need to modify, and that would be tracked. And then you can also change the revenue, the billing, all that stuff to reflect the new changes that are now applicable to this customer contract. That's kind of an overall flow, and any change you make is available to you as you sort of do your reporting. So next slide. So Adam went through 3 scenarios, and what I wanted to do was go through those and see how you could potentially handle them in Workday. This is in no way to say that this is the only way you should be doing it. Our customers and people who use the product are very creative, and they have a very flexible tool in their hands, so that depending on their business process, depending on many things, they can choose to use Workday in different ways. So these are a couple of ways that we think that you can handle each of these scenarios, but people do it differently. I think that's one key thing to note. So the first scenario that we discussed is where the contract is extended after 8 months for an additional 12 months. So this results in both change to the contract amount, rev rec, and then so to do that, there are a couple of ways on how you could potentially do this in Workday. In the first option, the Workday contract is amended. So we talked about the amendment process, and a new contract line for the additional 12 months would be added. Once you add that, a separate revenue schedule is defined for the extension, while the original contract line you would leave intact. And then revenue and billing templates that we already have in the system can be used to streamline the creation of this new revenue schedule. So that's the first option. Alternatively, you can choose to define a new contract with the new extension of the service, and then define rev rec and billing on that contract with really no impact to the current contract that you have. And then, as I mentioned before, you can link these contracts to indicate that this is an arrangement with the customer, these are related contracts, and one is the result of an extension to the original. So that's how we would go through looking at scenario number 1. Next slide. So the second scenario is when the original contract for the services you terminated after 8 months, and then the parties decide to extend the contract for an additional 12 months. So it's slightly different. It's not a straightforward extension. You know, from a business standpoint, you're terminating and you're deciding to extend it for an additional 12 months. So one way of doing this, in the first scenario, the contract line for the consulting service can be extended for the additional 12 months, again, using the amendment process. The revenue schedule then is regenerated, and this is done prospectively. So from month 9 to the end of the contract for the remaining contract amount. And then the reason for changing the contract can be monitored at the line level. Why did you make that change? You can track that at the line level. And then, the generation of the new installment amounts, the revenue schedule functionality provides that to easily generate those new installment amounts. Alternatively, you can handle it differently by end dating the current service contract line to month 8. So you already have a contract line, you can end date it using the start and end date for that contract line. And then on the same contract, you can add a new contract line with new start and end dates for the duration of the 16 months to which you're extending the contract. So the current revenue schedule would have to be slightly modified because you're not going to recognize for what you initially intended to. So you delete the remaining installments, and then the new revenue schedule for the 16 months with the new contract line can be established. So then again, yeah, based on your business process, reporting needs, you can choose either of the options and pretty much achieve the same RevRec result. All right, so scenario 3, next slide. Yeah, so this one is where we were extending the service for an additional 12-month period. And what we were doing is we were recording a cumulative revenue adjustment. So you were backing out what you had recorded, and you were going to, book a cumulative revenue adjustment in the month that the contract was modified. So the first option I have listed here, you would, again, amend the current contract. And the way to do the back out would be to add a new negative contract line, which is allowed in Workday. And that would basically back out all the revenue that you've recognized so far. You would also then add a new contract line for the entire duration of the contract, and you can add that. And then to handle the cumulative adjustment, the revenue adjustment that we were talking about, you would add a cumulative adjustment revenue installment for month 8. So month 8 is where you would define a cumulative adjustment, and then 9 onwards, you're pretty much recognizing revenue based on the new rules. So that's how you would do it. Back out first, book a cumulative adjustment, and then there onwards till the end of the contract duration, have a revenue schedule to recognize straight line or however else you want to do that. So, that flexibility is there. Alternatively, you could do it differently. You can amend the original contract line and extend the end date for that till the end of the period. And then on the current revenue schedule that you have, you could modify that to do a one-time revenue installment, to handle that cumulative adjustment. So, month 8, you would add an extra installment on the current revenue schedule, have that cumulative adjustment there. And then from month 9 onwards, prospectively, you would regenerate the revenue schedule, which is done automatically for the new duration of the contract. So 2 ways of doing it. We like both. It really depends on how you want to do it. The first one really ties everything together. So some people would prefer that. We do have a few customers who are already doing something similar even today. So those are the 3 scenarios. Next slide. So I know we're not doing a demo here, but if you do get a chance to look at a detailed demo, I just wanted to bring some of this up to you, some screenshots to show you where this is initiated from. So in my example, I had an approved and an active contract that I'd already built and done RevRec on. So from the header, once I realize that I have to modify this contract, I can initiate an amendment process. And once I've done that, I can populate an amendment reason, which is required. This is up to you. You can define multiple amendment reasons, on your tenant, and again, based on why you modify contracts, things like that. And then all the dates, the reasons, details are available to you for reporting. So once that contract goes into an amendment mode, there is a business process framework that kicks in. You can make those any modification we talked about, in the 3 scenarios. If you're modifying at a header level, great, you can do that. At the line level, you can make any of those modifications that, again, the scenario is covered. Once you submit it, an approval is triggered if that's how you've defined your system. And then, you go through that, the original contract is versioned, and then the new contract, the amended contract, is your new active contract. And then, of course, the revenue schedules are all regenerated to reflect the new contract terms. In this case, the amendment process I'm showing, I'm manually initiating it, but we have web services. So a lot of our customers who have this deployed, they can initiate, just like the creation of the contract can be initiated from an upstream CPQ CRM system, the amendment process, we have a web service, so that can also be handled through an integration using a web service. So you can pretty much fully automate the creation as well as the amendment, track all the changes, from an upstream system. So hopefully this gives you a good idea of, how you can handle simple to more complex contract modifications in Workday. The one thing I want to note is you do have an advantage here that all your transaction data, so my transaction contract and my amendment, my modification, all that is happening in the same system where you're doing revenue recognition, and all of it is tracked. So you're not bolting things on. The only thing you have is a CPQ CRM system upstream, but once you are on the contract, all of it is tracked in the same system, which is pretty good. You don't have to look at multiple places to figure out why things were modified, how they were modified. And then from an ASC 606 perspective, this is good news, because we all know that eventually you guys will spend a lot of time, doing disclosure reporting. So all your data in one place, and the amendments handled fairly seamlessly through web service framework. I think that's the key benefit here that you would realize. So that's all I wanted to cover for contract modifications, and I will pass it back to Adam.
Great. Thanks. Great information there. So let's dive into variable consideration now, our other main topic for this presentation. And I think this is one of the biggest conceptual changes between ASC 605 and ASC 606. So many of you are probably aware in today's guidance, you have this concept that you can't recognize revenue until the transaction price is fixed or determinable. Well, that goes away under ASC 606. The model under ASC 606 is if you have variable consideration, you estimate it from day one, you would combine it with any fixed portion of the transaction price, and that total amount then becomes your transaction price that you allocate to your performance obligations and the amount for which you're recognizing revenue starting from day one, even before the contingency is resolved. So, like modifications, I found variable consideration is very common. I think every company I've worked with has some form of variable consideration. And variable consideration is really just any form of consideration that's not fixed, that's contingent upon some variable that still has to be satisfied, still has to be determined in the future. So it could be bonuses, it could be penalties, it could be refunds, it could be royalty payments. I have a client that's an insurance broker, and they receive commissions for selling policies, but their commissions are contingent upon the policyholder paying the underlying premiums. So the transaction price for the insurance broker, my client, is not fixed until they know how long the policyholder is going to pay the insurance commissions or the premium payments. Any of you familiar with the hospitality industry? They'll have long-term contracts to manage a hotel on behalf of the hotel owner, and their consideration is typically based on a percentage of the hotel revenue. So obviously that is variable consideration as well. So again, just because variable consideration like contract modifications, it's so prevalent, so common, definitely an area you want to focus on and do not want to take lightly. Okay, so like modifications, I want to just run through a quick example, just to highlight some of these concepts and what the accounting is. So fact pattern: a provider of call center related products and services, the company, and a cable company, the customer, enter into a contract where the company will provide a software license for the company's call center software with a stated contract price of $50,000, call center support for 1 year with a stated contract price of $1 per call received. So these fees for the call center support is variable because it's dependent on the number of calls received. You don't know the actual amount from day one. I'm going to assume in this example that the software license and the call center support are separate performance obligations. So so the call center support represents a single performance obligation consisting of a series of daily distinct stand-ready services. This concept gets a little bit complex, bear with me, but I think it's important because it has a significant impact on how you can treat variable consideration. So going back to step 2 of the 5-step model, the general rule is if you have a distinct good or service, it's treated as a separate performance obligation. The one exception to that is when you have a series of distinct goods or services. And this is where you're providing, the company is providing the same thing as a series. And in which case you would combine all of those distinct promised goods or services into a single performance obligation. So the example you'll typically see is a cleaning company. Let's say they enter into a contract to provide cleaning services for a customer's office building on a weekly basis for a year. Now, each week of that cleaning service is distinct. It provides value independent of the other weeks of cleaning service. But because they're all substantially the same and meet other criteria we won't get into now, you would actually combine all of those into a single performance obligation. So instead of having 52 performance obligations, you have one series performance obligation consisting of a series of weekly distinct services. So in this example, if you think about the call center support, really the nature of the obligation is for the entity to stand ready to answer calls every day as needed. And the customer gets value from each day of those answering calls independent of the other days. So really each day is a distinct stand ready service, but because the series guidance or the series criteria are met, you would combine all of those distinct, all 365 of those distinct daily stand ready services into one single performance obligation. And why this is important is when it comes to variable consideration and allocating that variable consideration. So we'll go through scenario 1, which I think will help illustrate this concept. So in scenario 1, assume the contractually stated prices of the software license and the call center support represent the standalone selling prices. So in this case, what this series guidance says is if you have generally remember, going back to step 4, you would generally allocate your transaction price on a relative standalone selling price basis. One exception to that is if the variable consideration clearly relates to one or more performance obligations or one or more distinct goods or services in a series, you would allocate, and it's consistent with the overall allocation objective, you would allocate then that variable consideration just to the distinct goods or services within the series. So what this means for this example then is a software license of $50,000 would be allocated just to the software license performance obligation, and presumably it would be recognized as revenue upon providing that license. The variable call center fees, however, could be allocated to each distinct period of service, so each day, or you accumulate them into the month if the month is when billing happens. If you think about it, because of that, let's say in month 1 there's 500 calls, you would allocate that $500 just to month 1, and because you've satisfied that service in month 1, you would recognize all $500 of that revenue in month 1. And what that means is it kind of gets you out of actually having to estimate the variable consideration from a practical perspective, because you're allocating it to just that month of service and you're recognizing that month of service. So really scenario 1 is probably consistent with how companies would treat it today, and I think a much better answer from an operational ease perspective than the normal model, which we'll get into in scenario 2. So scenario 2, assume a standalone selling price of the call center support is $3 per call received, rather than the $1 per call received. That's the actual contract price. So because of this, if you just allocate these variable consideration to distinct services as we did in scenario 1, it's not meeting the allocation objective, because the allocation objective is you would allocate an amount for which you would expect to be entitled for performing just that service, and you would expect to get $3 per call rather than $1 per call. So because of this, you default to the basic or the general variable consideration model, where you have to estimate the variable fees, combine it with your fixed fees, and then allocate the total transaction price across all performance obligations. So where that leaves us in the scenario is, the variable call center fees, assume the estimate's 5,000 calls per year. So the estimated variable fees on day 1 is $5,000. So you would have a total transaction price of $55,000, which then gets allocated across both performance obligations on a relative standalone selling price basis. And then the amount allocated to each performance obligation is recognized as that performance obligation says. So, just thinking through this obviously creates a lot of additional operational challenge that scenario 1 does not. So scenario 3, just to build on scenario 2, really the same example of scenario 2, except we're assuming midway through the year, the estimated calls are revised to 6,000 from the initial estimate of 5,000. So now what happens is your transaction price was initially 55,000, it becomes 56,000. You would then have to reallocate that additional $1,000 to your performance obligations based on the same percentages you originally allocated, and then you would record a cumulative revenue adjustment, kind of just like you would do if you go back to the modification scenario 3. That's what you have to do every time there's a change in estimate of variable consideration. Probably just going through this one example, you probably realize this is pretty complex, and this is just one example. If you think about a customer or a company that has hundreds, if not thousands, of contracts with variable consideration, you can imagine this could get very complex from an operational perspective. So now just discussing some of the practical considerations around variable consideration. So just like with modifications, through your assessment, through your technical analysis of your implementation of ASC 606, have you identified all the various types of variable consideration you have, and you've concluded on the appropriate accounting? Is it appropriate to allocate to distinct goods or services in a series, or do you have to estimate it from day 1? So just like modifications, ideally you would have been able to identify all these various scenarios in your assessment, and then you can kind of create more of this factory type model with your ongoing accounting. But again, variable consideration is so common, there's so many different types. If you weren't able to do that, it's going to be a case-by-case analysis that's going to be done on an ongoing basis as your contracts have variable consideration. Then just thinking about this ongoing process, the way I think about it, first what you need to do is identify a contract that has variable consideration. Then determine whether that variable consideration can be allocated to distinct goods or services in a series, and that's scenario 1 from the previous slide. If not, then you have to estimate that variable consideration at contract inception, and how do you estimate it? And then finally, you have to update those estimates every quarter, and every time there's an updated estimate, you would have to calculate the cumulative revenue adjustment. So just like with modifications, I think the actual accounting for this, you'll want to consider, is there a way to leverage IT systems? Because if you have thousands of contracts that every quarter you have to calculate a cumulative revenue adjustment, it could get very complex and very time consuming. Again, I think I'll stop there and turn it over for further discussion on some of the IT considerations.
Great, thanks, Adam. So variable consideration in Workday, as I mentioned earlier, so contract lines are pretty key in Workday, and they give you a lot of flexibility and revenue recognition billing, right? And they determine what you can do. So variable consideration is also supported through 2 contract line types that we have in Workday, and one is called usage, so it's a contract line type, and then the other one is variable line. So I'll first talk about usage and show you an example of how we would do this. So basically, the usage contract line type allows billing and rev rec for customer contracts where the usage count is not known upfront. So in the example that Adam discussed, the call center support would be a usage line in Workday. The software license is a subscription line. The call center support is a usage line because we don't know how many calls we're going to get in a particular month. So the usage count is not known. You do know the per usage rate upfront. So again, in the example, the per usage rate was $1 per call. You can have other pricing mechanisms and strategies that you want to use to rate that usage. But you do know that this is going to be how you would rate usage once you get it. And then typically the business is recurring in nature, so you're going to get call center calls every month. So to support that whole infrastructure, those three specific use cases, we have this whole infrastructure with the usage contract line type. So next slide. So I want to just walk you through the first scenario that we talked about, where the customer contract has a service subscription along with the usage components. So in my example, the contract I'm showing, the first line is a usage-based line. So you don't know what you're going to bill, you don't know what you're going to recognize upfront. And the second line is a subscription line where the amount is known upfront. So in this case, it was $50K. So this whole contract is what you will first set up to model that use case. And the subscription line you already know is $50K. You would set it up with that amount, and that's going to be how you would initiate this contract. Next slide. So the next thing is that the subscription line is pending delivery milestone, as we talked about. So you cannot recognize revenue on that until you have delivered the software license. So that you would handle through what we call a milestone, and I'll talk about it. And you can see that in the schedule definition that for this particular service subscription line, it is pending a milestone. The usage line is ready to go. So if you've started as soon as you start recording usage, once the contract is approved and everything, you can start billing and revenue and doing rev rec as usage is reported. Next slide. So for the first subscription line, what I want to highlight is that we support milestone management. So in this example, what I did was I tied the contract line, billing and rev rec to a milestone of software delivery. You can set that whole thing up. And then once that milestone is complete, you mark that milestone as complete. And then the billing and revenue schedules are also marked as milestone complete. And once that milestone is met, so you're ready to start processing. In this example, the $50K is ready to bill, and rev rec can happen once that software license delivery has been completed. Next slide. So that's the subscription piece tied to a milestone. For the usage line, the format is slightly different. So you would report usage at the end of the month, typically through this very specific task and this UI. You tie the usage to a particular contract line, and then you process the invoice. Processing the invoice basically means the usage is rated based on the usage price rate sheet that you've already created. And that usage price rate sheet supports your pricing methodologies. So if you have tiered pricing, if you have certain types of minimum commits that customers have to pay, all that can be modeled using that usage price rate sheet. So you report the usage, it gets rated, it can be invoiced, and as soon as you invoice it, that revenue gets recognized. So that's kind of the first use case that we talked about. You can have use cases where the usage revenue has to be recognized separately from billing. So as transactions come in and they get recognized, you should not be recognizing the usage revenue that's deferred. We've seen those types of use cases. So we do allow for that also. You can choose the option on the usage contract line to defer rev rec and then define a separate revenue schedule on how you want to recognize revenue for that particular usage line. So this is how we would handle variable consideration. You don't know the usage amount up front. It is reported on a periodic basis, and you would do rev rec and billing once the usage amounts are known. So that's the framework to support, that first scenario. Next slide. For the other scenarios where variable consideration has to be estimated, the variable line allows customers to create billing and revenue installments based on that estimated amount. And then when actuals are reported, the estimated amount can be adjusted to actuals by reviewing and then manually adjusting that amount. So for example, if $1,000 were estimated, recognized up front, but the actuals are only $800, you can do a negative $200 installment to the revenue schedule and then correct the rev rec. So that's how we would handle. So when you're looking at variable consideration, definitely look at usage and variable line type, and a lot of flexibility there again in how you would handle it. With that, I'm going to hand it over to Mike to cover some other considerations with rev rec.
Thank you, Risha. So I'm Mike, and I'll cover some of the 606 transition feature support that Workday also developed. So we actually offer two solutions to different types of 606 transition plans that customers may have. The first one is what we call alternate contracts, which actually creates mirror contracts of existing contracts on Workday. This allows actually customers to remodel their existing revenue schedules to see the difference between the 606 and 605 transition. And they could actually edit these contracts without having to affect their common books with their GL. So this is quite a flexible tool for customers to use during this time. And the second one is a link contract. Link contract allows customers to actually establish relationships with existing contracts that are sitting on their common books. So this allows a platform for customers to actually just, if they simply from the 606 transition assessment, they simply need to reallocate revenue among the existing contracts, they could use this, like a simpler feature. So with that, I will pass it back to John.
Great, thanks. As I mentioned, we need to do the 3 polling questions. This is an important part to be able to be eligible for the CPE credit. So we are going to cover 3 polling questions. The first question is, what is your primary technology approach for adopting 606? Is it manual with spreadsheets or equivalent? B, utilize your existing system? C, implement a new system, or you're not quite yet sure? We'll give you a few moments to answer the poll, and we'll tabulate the results. All right, let's see the results. "35% of you plan on using your existing system, which is the highest of the first 3. 12% plan on using Excel, 14% are looking for a new technology solution, and 39% are not quite sure yet. So hopefully this webinar gave you some food for thought if you're not quite sure where you're leading, as well as guidance if you're going to use an existing system or do it via spreadsheets. We're going to move on to our next poll question. The next poll question is, are you planning to use an automated or manual, such as Excel spreadsheet or equivalent, solution to account for contract modifications? Do you use an automated solution or a manual solution? And the poll is up. This one should be a little easier, only 2 choices. Give it a couple more seconds if you haven't voted. All right, now we're going to share this poll. 53% of you are looking to do an automated solution, and 47% is manual. Hopefully the information, if you're going manual, that Adam gave you, we'll give you some good guidance to go through. And as you grow, I think it really comes down to a matter of scale. How often do things happen to you? How many contracts do you have? How many contracts have the variable consideration, which might lead you to another solution down the road. Our third poll today is, do you expect a significant impact, sorry about that, from adopting 606 related to variable consideration? And again, an easy yes or no. And again, this is going to be based on your business and your business model. Okay. So I'm going to close the poll and share it with you. 73% of you said you do not expect this. 27% of the participants online did. It's pretty consistent with what we've seen. So that is our main webinar for today. We do have time for a question. The key takeaways around contract modifications, variable consideration, and technology are listed here. While I field the question, you can take a quick read of that. But our first question is about technology. And it was specifically for Mike or Risha, how would Workday support disclosure reporting related to 606?
So there are already standard reports that would actually support some of the roll forward that they'll see with the 606 disclosure requirements involving deferred revenue. And we're currently working with existing customers and to open up even more data sources to make reporting even more robust. And there is a feature in Workday named Worksheets, which will actually allow you to create pivot tables within Workday from different data sources. So that's how we are kind of attacking our data reporting from that aspect.
Okay. I think we have one more question. It's probably for Adam. Does upsell, meaning only a change in quantity, fall in scope of contract modifications?
Yeah, it would. If you go back and remember the definition of a modification, it's a change in the scope or price of a contract, and this would be a change in scope. So you would have to, go through the modification guides, the modification model to determine the appropriate accounting for it.
Yep. The last slide we're going to show you is a little bit about the CPE qualification. We'll be in contact with you if you participated and did the polls to make sure we get your CPE credit. We did get some other questions. We don't have time to answer them, but we'll send them out as a follow-up with our answers. I want to thank everybody for participating. Thank you to Risha and Mike from Workday for co-doing the webinar with us, and of course, Adam, our revenue recognition expert. Thank you very much. And like I said, if you have any questions, please direct them back to the folks that organized the webinar, so Tyson and the marketing team here at CrossCountry. Thank you very much. Have a great day.